ever wish you could kind of see into the future, especially when it comes to your money?
Haha.
Well, today's deep dive, all about getting that financial foresight.
Oh,
We're
exciting.
tackling the time value of money,
Okay.
guided by a chapter from a corporate finance textbook.
Nice.
So by the end of this, you'll be able to confidently evaluate investments and decode those interest rate acronyms.
Mm.
You know, APR, EAR,
all the good stuff.
all that.
Yeah.
All right, let's dive in. What's often overlooked is the simple fact that money today, it's inherently more valuable than the same amount, in the future.
Yeah, that's true. It's a concept that a lot of people don't immediately think about.
Yeah.
But it's so important.
It's almost like money has this hidden superpower.
Yeah.
Its ability to grow over time.
Exactly. And that's where the concept of opportunity cost comes in.
Oh, okay.
So think about it this way. If you have money today, you could invest it. Potentially earn some interest or returns. Every day you wait, it's a missed opportunity for that money to grow.
So it's not just about the dollar amount, it's about the potential that dollar holds over time.
Exactly.
Like comparing a seed to a fully grown tree.
That's a great analogy. I like that.
Right.
And to help us compare those seeds and trees, we need something like an exchange rate.
Okay.
That's where the interest rate comes in. It acts as a bridge between the value of money today and its value in the future.
Makes sense. Just like when we're, traveling to another country, got to convert our currency to big purchases.
Right.
So with time value of money, the interest rate is our conversion tool.
Precisely. And without factoring in this time value, we're essentially comparing apples and oranges, when making financial decisions.
So how do we, actually navigate this financial time machine,
Wow.
I know the textbook talks about 3 time travel rules for cash flows.
Yeah, the first rule is all about making sure we're comparing apples to apples.
Right.
We can only compare or combine values that exist at the same point in time.
So no comparing a dollar today to a dollar 5 years from now.
Yeah.
Without, doing some time traveling conversions first.
Yeah, exactly.
It's like trying to add meters and feet without converting them to the same, measurement.
Yeah, exactly. And that brings us to rule number 2, moving cash flows forward in time through the magic of compounding.
Oh, yeah, compounding is like a financial superpower.
It is. It really is. Imagine investing $1,000 at a 10% interest rate.
Okay.
After 1 year, you earn $100 in interest, giving you $1,100. But here's the key. In year 2, you're earning interest on that $1,100.
Right.
Not just your initial investment.
So your money is literally making more money.
Exactly. And the longer you let it compound, the more exponential the growth becomes. The textbook has a really interesting example. That same $1,000 invested at 10% interest would grow to almost $2,000 after 7 years.
Oh, wow.
And after 20 years, it's over $6,700.
That's amazing.
That's powerful.
It's like watching a tiny snowball roll down a hill and turn into a giant snowball.
I like that visual.
Right.
Yeah, it's a great way to picture it. And it highlights the importance of starting to invest early and harnessing that power of compound interest.
For sure, yeah. Compound interest is a force to be reckoned with. But we can't always just send our money into the future, right?
Yeah.
Sometimes we need to bring those future dollars back to the present.
Exactly.
That's where rule number 3 comes in.
Yes. Rule 3 is all about discounting, bringing those future cash flows back to their present value.
Right.
It's essentially like asking, how much is that future money worth to me today?
So it's like using our time machine to see what a future paycheck would buy in today's market.
Precisely. And this concept is crucial, when we're evaluating investments or making financial decisions that involve costs and benefits spread out over time.
Got it. So once we know how to time travel our money, how do we actually use that to make smarter decisions?
That's where the concept of net present value, or NPV, comes in. It's a really powerful tool that helps us weigh the present value of benefits against the present value of costs, for an investment opportunity.
So it's like putting all the costs and benefits on the same timeline, seeing if it's worth it in today's terms.
You got it. And choosing the option with the highest NPV is like receiving its NPV in cash today. Think of it this way. If an investment has a positive NPV, it means it's expected to generate more value than it costs, essentially putting money in your pocket.
I like the sound of that. But I imagine calculating NPV can get a little complex at times. I think the textbook has an example about buying a printer.
It does, it does. And it's a great example of how NPV can reveal hidden value.
Okay.
So imagine a company needs a new printer, costs $9,500. The manufacturer offers a deal. Pay $10,000 in a year.
Okay.
Or pay cash today.
So at first glance, waiting and paying more seems like a bad deal.
It might seem that way, but that's where NPV helps us see the bigger picture. Considering a 7% interest rate, the NPV of that delayed payment deal actually works out to be like getting a $154 discount
Why?
compared to paying up front. It's like finding cash in your pocket.
That's a deal I wouldn't want to miss.
Yeah.
It's amazing how MPV can help us uncover hidden value in what seem like, simple transactions.
For sure. And that's just the tip of the iceberg. As we dive deeper into the world of finance, we'll see how this time value concept is fundamental to everything.
Oh, wow.
From loans and mortgages to investments and retirement planning.
This is already blowing my mind. But let's be honest, not all financial decisions are one-time transactions, right?
Right.
What about situations where we have, like, ongoing payments or cash flows?
That's where the concepts of perpetuities and annuities come into play.
Okay.
Helping us simplify calculations for scenarios with recurring cash flows.
Okay, I'm intrigued. Let's start with perpetuities. What exactly are they, and how do they fit into this whole time value puzzle?
So a perpetuity is essentially an endless stream of equal payments.
Oh, wow.
Happening at regular intervals. Imagine a magical money tree that keeps producing the same amount of fruit year after year.
Okay, yeah.
That's the idea behind a perpetuity.
A never-ending stream of income. That sounds almost too good to be true.
It does, and it kind of is in most cases, but there are some real-world examples.
Oh, okay.
One example mentioned in the textbook is the Consul. It's a British government bond that pays a fixed amount forever.
Oh.
They've been around for centuries.
Wow.
Another, maybe more relatable example could be setting up a scholarship fund
Okay, yeah.
that awards the same amount each year, indefinitely.
Now, that's a legacy that would keep on giving. It's amazing how we can use these financial tools, to create lasting impact.
Absolutely. And understanding how to value these perpetuities is essential for making informed decisions about long-term financial commitments.
So if we wanted to fund, say, a scholarship that pays out $10,000 every year, forever, how would we even begin to calculate that?
It might sound daunting, but the math is actually pretty straightforward. Let's say we can expect an 8% annual return on our investment.
Okay.
Using the perpetuity formula, we would need to invest $125,000 upfront to generate that $10,000 in interest each year,
Oh, wow.
ensuring the scholarship keeps running forever.
So with one strategic investment, we've created a perpetual scholarship fund. That's incredible.
It is.
It really highlights the power of understanding these time value concepts and how to apply them
Yeah.
to achieve, our financial goals.
It really is.
Perpetuities definitely have a certain appeal. Who wouldn't want an endless stream of income?
Exactly.
But not everything lasts forever. What about when we're dealing with payments over a fixed period, like a car loan or a mortgage?
That's where annuities come in.
Okay.
Unlike perpetuities, annuities involve a predetermined end date and a fixed number of payments.
So an annuity is like a perpetuity with an expiration date?
That's a great way to think about it.
Yeah.
The textbook uses Ellen's retirement savings as an example. Let's say she consistently saves $10,000 each year until she retires at 65.
Okay, yeah.
That's 30 years of dedicated saving.
That's some serious saving power. So how do annuities help us understand her future retirement nest egg?
Well, we can use the annuity formula to calculate how much her savings will have grown by the time she retires, considering the time value of money and her assumed interest rate.
Okay.
It's like fast-forwarding through those 30 years and seeing the impressive result of her consistent saving efforts.
This is making me rethink my own saving strategy.
Yeah.
But I've always found interest rates to be a bit of a mystery,
Yeah.
All those acronyms, APR, ER, what's the deal with those?
Yes, the world of interest rate jargon.
Yeah.
It can definitely be confusing.
Yeah.
It's important to understand the difference between the annual percentage rate, or APR, and the effective annual rate, ER.
Okay. So is one better than the other?
It's not about one being better. It's about knowing which one to use in different situations.
Yep.
APR is often used for marketing purposes
And
and can be a bit misleading because it doesn't fully account for the impact of compounding.
So it's like seeing a delicious-looking cake in an ad, but then you find out it's only a picture, and the actual cake is much smaller.
That's a great analogy.
Right.
ER, on the other hand, gives us the real picture. It reflects the actual amount of interest earned in a year, taking into account how often interest is compounded. So
That,
year is like seeing the actual cake, getting
yeah,
the full delicious experience.
right.
Let's say you see an ad for a savings account offering a 6% APR compounded monthly.
Okay.
What that really means is you're earning 0.5% interest each month. And thanks to the magic of compounding,
Right.
that results in an year of over 6.16%. That extra 0.16%, it's coming from earning interest on your interest.
Wow. Those
Yeah.
seemingly small decimals can really add up over time.
They do, they do. So when calculating loan payments, investment returns, or really anything involving interest, we should always use ERR.
Got it. So ERR is our go-to tool for accurate financial time traveling.
Precisely. And remember, if your cash flows don't line up perfectly with the compounding period, you'll need to adjust the discount rate accordingly.
Okay, cool. So we've covered the kind of the foundation of the time value of money. We've learned the 3 rules for navigating our financial time machine.
Right.
And even tackled those tricky interest rate terms. I'm feeling like a time-traveling financial wizard already.
Uh-huh.
Where do we go from here?
Now that we've got the basics down, let's explore some real-world applications, like loans. We'll learn how to calculate loan payments, figure out outstanding balances, and even touch on how risk and taxes can influence interest rates.
Sounds like we're about to take our financial literacy to the next level.
Exactly.
Awesome.
Get ready for part 2 of our time value deep dive. We'll uncover even more financial insights and empower you to make some savvy money decisions.
Can't wait. Welcome back to our deep dive into the time value of money. Last time we explored the power of compounding and learned how to time travel our money. Are you ready to put those skills to the test with some real-world scenarios?
Absolutely. Let's start with a scenario that I think a lot of us can relate to, taking out a loan.
Okay, so let's say I'm eyeing a shiny new car. Price tag of $30,000. The dealer's offering a loan with a 7% APR and monthly compounding.
Sounds like a perfect opportunity to apply our time value knowledge.
So where do we even begin? I know we need to figure out the actual monthly interest rate we'll be paying.
You're right. We can't just take that 7% APR at face value. Remember, APR doesn't tell the whole story because it doesn't reflect the effect of compounding.
So it's like those serving size labels on food packages. Sometimes you think you're getting a lot, but then you realize the actual serving is much smaller.
Yeah. That's a great way to put it. We need to break that 7% APR down into a monthly rate to see what's really going on.
Okay.
Using that formula we talked about earlier, that 7% APR translates to a monthly interest rate of approximately 0.583%.
Okay, so we've uncovered the real interest rate. Now, how do we use that to figure out what our monthly car payment will be?
Well, this is where our knowledge of annuities comes in handy.
Okay.
We can treat those monthly loan payments as an annuity because they're a series of equal payments over a set period of time.
So it's like paying rent for our car each month.
Yeah, that's a good analogy. We know the present value of this annuity, which is the loan amount, $30,000. We also have the monthly interest rate and the loan term, let's say it's 5 years or 60 months.
So we've got all the pieces of the puzzle. Now, how do we put them all together?
Using that annuity formula, we can solve for the monthly payment. In this case, it works out to be around $590.50.
So thanks to our time value toolkit, we've decoded our monthly car payment. But what about those times when you want to pay off a loan early? How do you figure out how much you still owe?
That's where the concept of present value comes back into play. The outstanding balance on a loan is essentially the present value of all your remaining future payments.
So it's like hitting the pause button on our financial time machine and taking stock of where we stand today.
Exactly. Let's say after 2 years of diligently making those car payments, you decide you want to pay off the remaining balance in one lump sum.
That's a great feeling,
Yeah.
getting rid of that debt. But how do we actually calculate that remaining balance?
It's all about bringing those future payments back to the present. We would calculate the present value of those remaining 36 monthly payments using the same monthly interest rate of 0.583%.
So it's like rewinding our time machine and seeing what those future payments are worth today. This is making me feel like I have X-ray vision into my finances.
It is a powerful tool, and understanding these concepts can really empower you to make more informed financial decisions.
But loans aren't the only things affected by interest rates, right? I know the textbook also mentioned risk and taxes. How do those factors kind of come into play?
Risk and taxes are essential ingredients in the interest rate recipe. Think of it this way. Investors expect a higher return when they take on more risk.
Okay.
That's why riskier investments tend to come with higher interest rates. It's all about balancing that risk and potential reward.
So it's like a financial seesaw.
Yeah.
The higher the risk, the higher the potential reward, but also the higher the interest rate.
Exactly. And then there are taxes. Interest earned on investments is often taxable,
Right.
which reduces the net return. So this means that investors need to consider after-tax interest rates, when comparing different investment opportunities.
Got it. So risk and taxes, two important factors to keep in mind when navigating the world of interest rates.
Speaking of interest rates, the textbook dives into this really fascinating concept called the yield curve.
Yield curve. That sounds intriguing. What is that all about?
The yield curve is basically a visual representation of the relationship between interest rates and the time until those rates mature, or, the term. It's like a snapshot of interest rates across different time horizons.
So instead of just looking at a single interest rate, we're looking at a whole spectrum of rates across different maturities.
Precisely. And the shape of this yield curve, it can provide valuable insights into the economy and future interest rate expectations.
So it's like a financial crystal ball.
In a way, yeah. For example, a steeply increasing yield curve where long-term rates are much higher than short-term rates often suggests that investors expect interest rates to rise in the future.
So a steep yield curve is kind of like a heads up that interest rates might be heading north.
That's a good way to think about it. On the other hand, a decreasing or inverted yield curve where long-term rates are actually lower than short-term rates can signal an expected decline in interest rates.
Okay, so a downward sloping yield curve might be a sign that interest rates are about to take a dip. But why would interest rates decline?
Well, interest rates often fall during economic slowdowns, so an inverted yield curve can sometimes be a warning sign of a potential recession.
Wow. So the yield curve isn't just a bunch of lines on a graph. It's a potential economic indicator. I remember the textbook mentioned a specific example, right?
It did. It pointed to November 2006 when the U.S. yield curve was inverted, and as we know, a recession followed. It's a fascinating example of how the yield curve can reflect investors' expectations about the future economy.
This is all incredibly insightful. But let's get back to the practical side of things. How do we actually use this yield curve information when calculating present values?
So when dealing with cash flows that occur at different points in time, we need to use the corresponding interest rate from the yield curve for each of those cash flows.
Okay, so if we have a cash flow coming in 2 years, we'd use the 2-year interest rate from the yield curve, and so on.
Exactly. And this highlights a really crucial point. All those handy shortcuts we learned about the annuity and perpetuity formulas, they work great when we have a constant discount rate. But when interest rates vary over time, like we see reflected in the yield curve, we need to be more precise and discount each cash flow with its corresponding rate.
So no cutting corners when the yield curve throws us a curveball.
Precisely. We need to use the full formula and consider those specific interest rates from the yield curve to get an accurate present value.
Got it. Accuracy is key when we're dealing with the intricacies of the time value of money. Welcome back to the deep dive. We've been on quite a journey exploring the time value of money.
We have.
We've learned how to navigate our financial time machine, decoded those tricky interest rate terms, and even explored the predictive potential of the yield curve.
Yeah.
I feel equipped to tackle all sorts of financial challenges now.
It's amazing how these seemingly complex concepts can become so much clearer when we break them down and relate them to everyday experiences.
Exactly. And speaking of making things clear, I remember you mentioned that when interest rates fluctuate over time, we need to be extra careful when calculating present values.
You're absolutely right. Let's illustrate this with an example. Imagine we need to calculate the present value of a risk-free 5-year annuity. It pays, let's say, $1,000 per year.
Okay, so we're dealing with, stream of equal payments over a fixed period.
Precisely. But here's the catch. We can't just grab the 5-year interest rate from the yield curve and plug it into our handy annuity formula.
So those shortcuts we learned about earlier don't always apply.
Well, they're still valuable tools, but we need to use them strategically.
Okay.
In this case, because interest rates might vary over those 5 years, we need to be more precise.
Gotcha. So what's the right approach then?
We need to look at the yield curve and use the specific interest rate for each year of the annuity. So for year 1, we use the 1-year interest rate.
Okay.
For year 2, we use the 2-year interest rate, and so on.
It's like custom tailoring our calculations to match the unique shape of the yield curve.
That's a great analogy. It might seem like a bit more work, but it gives us a much more accurate present value calculation, especially when those interest rates are, kind of dancing all over the place.
It's like fine-tuning our financial instrument to capture those subtle nuances of the market.
Mhm.
This deep dive has truly been an eye-opening experience. We've uncovered the hidden power of the time value of money,
Hmm.
demystified all that interest rate jargon,
Right.
and even explored the predictive potential of the yield curve.
It's been quite a journey.
It has. I feel much more confident in my financial literacy now.
And that's the beauty of understanding these concepts. They provide a framework for making those informed financial decisions, whether it's evaluating those investment opportunities or understanding the true cost of a loan or even planning for a comfortable retirement.
Exactly. It's all about empowering ourselves to make those smart choices with our money.
Absolutely. And remember, financial literacy is a journey, not a destination. The more we learn and explore, the better equipped we'll be to navigate the complexities of the financial world.
Well said. So before we wrap up this deep dive, let's leave our listeners with a thought-provoking question to ponder. Imagine you've just won a substantial prize.
Okay.
You have two options. You can take a lump sum payment today, or you can receive smaller payments spread out over time. Which would you choose? And how would you factor in the time value of money to make the smartest choice?
That's a great question to consider. It really challenges us to apply all this newfound knowledge of time value and interest rates and even the yield curve to a real-world decision.
We'd love to hear your thoughts. Share your insights and keep diving into the fascinating world of finance. Until next time, keep those brains buzzing and those wallets happy.